Verified SSA payment data and Medicare billing records confirmed within the last 72 hours show 5 separate deduction mechanisms running simultaneously against Social Security retirement, SSDI, and survivor checks in 2026. And most seniors being affected were never clearly told these deductions were coming or that they had the right to appeal them. If your deposit has been lighter than expected and nobody at SSA has explained why, what I am about to walk you through names every one of these deductions, tells you exactly who they hit, and shows you which ones you can fight right now. This update is for every Social Security recipient who has watched their deposit shrink without explanation, received a letter from SSA they could not understand, or simply wants to know which deductions are hitting checks right now and which ones they have the legal right to reduce, appeal, or stop entirely. 5 days ago, I received a message from a 70-year-old retired school teacher named Evelyn from Columbus, Ohio. Evelyn taught 3rd grade for 33 years and retired feeling prepared for what her monthly income was going to look like. She had her Social Security amount on a notepad, her Medicare premium underneath it, and the net number at the bottom. That bottom number was what her entire budget was built around. Then January arrived, and her deposit was smaller than that number. Not by a lot, but enough that she noticed. She rechecked her math, looked at her bank statement 3 times, pulled out the SSA letter from the previous fall. Nothing explained the number that had actually arrived. Her utility bill was on the kitchen table. Her prescription copays had gone up. She called SSA and waited on hold for over an hour before the call dropped. February came with the same smaller number. March came the same way. 3 months of deposits, each a little short. No letter explaining any of it. And a growing conviction that something was being taken from her check she had never agreed to. She wrote to me and said, "I am not someone who panics easily. I taught school for 33 years, and I know how to read a document. But I cannot figure out where this money is going, and I cannot get anyone on the phone to explain it. Is somebody taking money out of my Social Security without telling me? And am I allowed to stop them?" Evelyn, several of these deductions are happening with little or no notice, and several of them can be reduced or stopped entirely. Let us go through all 5 of these deductions clearly and directly, because understanding which one or which combination is affecting your specific check is the only way to know what action to take, and several of them share a common characteristic that is worth naming up front before we dig in. They are all, technically, legal. They were all authorized somewhere in federal law or SSA policy, but the majority of seniors affected by them were never clearly told they were coming, never shown the specific dollar amount being withheld, and in many cases, never told they had the right to appeal, reduce, or stop them. That combination, legal but invisible, is exactly what makes them dangerous for someone like Evelyn, who is managing a fixed income down to the dollar. Deduction number 1 is the Medicare Part B premium, and this is the most widespread of the 5 because it affects virtually every senior enrolled in Original Medicare whose benefits are paid through Social Security. The standard monthly Part B premium for 2026 is $202.90, an increase of $17.90 from the $185 that most beneficiaries were paying at the end of 2025. That $17.90 increase was deducted automatically from January payments with no opt-out, no election form, and no separate notification beyond the annual Medicare cost announcement released in November. For a beneficiary who had calculated their net Social Security check using the 2025 premium figure, January arrived with $17.90 less than expected. February arrived the same way, and March has arrived the same way again. And if nobody told Evelyn the premium had changed, she has now lost 3 months of budget planning because of a number that changed with no direct personal notice sent to her. The fix for this specific deduction is not an appeal, and it is not a reversal. Part B is not optional for most Medicare enrollees, and the premium is set annually by the Centers for Medicare and Medicaid Services, which means the $202.90 deduction is going to continue. What Evelyn can and should do is verify at Medicare.gov that the exact amount being deducted from her check matches the correct standard premium for her income level, because if the deduction is higher than $202.90, that brings us directly to deduction number 2. Deduction number 2 is the IRMAA surcharge, which stands for Income-Related Monthly Adjustment Amount, And this is the one that is catching a significant number of retirees completely off guard in 2026 because of the way it is triggered and the way the income it is based on is calculated. IRMAA is an additional surcharge added on top of the standard $202.90 Part B premium for beneficiaries whose income exceeds specific thresholds. And for 2026, those thresholds begin at $109,000 per year for single filers and $218,000 per year for those filing jointly. If your income in 2024 exceeded those amounts, you are paying IRMAA this year. The surcharge itself is not moderate. On top of the base $202.90, IRMAA adds between $81.20 and $487 per month, depending on which income tier you fall into, pushing total Part B premiums as high as $689.90 per month for the highest earners. And there is an additional IRMAA surcharge on Medicare Part D prescription drug coverage ranging from $14.50 to $91 per month, on top of whatever your drug plan premium already costs. But here is the piece of IRMAA that is catching people who would not normally consider themselves high earners. IRMAA is calculated using your modified adjusted gross income from your 2024 tax return, which is the most recent filing the SSA could obtain from the IRS before setting 2026 premiums. If 2024 was a year where your income was higher than your typical retirement income, perhaps because you sold a home, took a large IRA withdrawal, converted funds to a Roth account, received a one-time inheritance, or received a retroactive Social Security payment under the Social Security Fairness Act, that single year of elevated income could push you into an IRMAA tier, even though your 2026 income is substantially lower. And IRMAA operates as a cliff, not a gradual scale, which means $1 over a threshold triggers the full surcharge for that entire tier, not just on the income above the line, and the difference between tiers can be over $1,000 per year. The good news is that IRMAA is one of the deductions in this list that can be formally appealed when income has changed significantly. The form is called SSA-44, Life-Changing Event, and it allows beneficiaries to request a reassessment of their IRMAA tier based on more recent income data, rather than the 2024 return the SSA is currently using. Qualifying events include retirement, the death of a spouse, divorce, or a significant reduction in income from any source. If your 2025 or 2026 income is substantially lower than your 2024 income for any of those reasons, filing Form SSA-44 with supporting documentation can reduce or eliminate your IRMAA surcharge going forward and restore that money to your monthly deposit. Contact SSA at 1-800-772-1213 to request the form, or download it directly at ssa.gov. Deduction number 3 involves federal student loans, and this one requires careful and specific explanation because the facts are more nuanced than most coverage of this topic has acknowledged. Federal law authorizes the Treasury Department's offset program to collect on defaulted federal student loan debts by deducting amounts from federal benefit payments, including Social Security, up to a maximum of 15% of the monthly benefit, with the first $750 per month protected and completely exempt from offset. SSI is also fully protected and cannot be reduced for student loan debts under any circumstances. The Treasury Offset Program for student loans was restarted by the Department of Education on May 5, 2025, after a multi-year pause that began during the pandemic. However, due to significant public backlash and legal concerns, Social Security offsets specifically were paused again by June of 2025, meaning actual deductions from Social Security checks for student loans were suspended before they were broadly applied. The July 4, 2025 One Big Beautiful Bill explicitly reauthorized these collection tools, and the pause remains technically temporary, meaning the Department of Education can resume Social Security offsets at any point without a new law being passed. Approximately 5.5 million borrowers are currently in default on federal student loans. If you have a defaulted federal student loan and you receive Social Security retirement, SSDI, or survivor benefits, not SSI, this deduction is not actively hitting your check today as of March 2026. But it is legally authorized to resume, and if it does, You are entitled to receive advance written notice before any offset begins. If you have defaulted federal student loans and want to avoid this deduction entirely, calling the Default Resolution Group at 1-800-621-3115 and enrolling in a rehabilitation plan or income-driven repayment removes you from offset eligibility entirely. Deduction number 4 is federal income tax withholding, and this is the deduction that the largest number of seniors do not realize they themselves may have authorized and then forgotten about. Social Security benefits become partially taxable when a beneficiary's combined income crosses certain thresholds that have not been adjusted for inflation since 1984. Combined income is defined as your adjusted gross income plus any tax-exempt interest plus half of your Social Security benefit. For a single filer, that combined income number must stay below $25,000 to avoid any taxation on benefits. Between $25,000 and $34,000, up to 50% of benefits may be taxable. Above $34,000, up to 85% of benefits may be taxable. For joint filers, the lower threshold is $32,000 and the upper is $44,000. Because these thresholds have not been updated since they were written into law, inflation has quietly pushed more and more seniors into the taxable range every year, even without any increase in their real purchasing power. When seniors realize this tax liability exists, or when they receive a surprise bill from the IRS at tax time, many of them file Form W-4V with SSA to request voluntary federal income tax withholding directly from their monthly benefit. That withholding comes in 4 options: 7%, 10%, 12%, or 22% of each monthly payment. Once that form is on file, it remains active until the beneficiary files a new form to change or cancel it, which means a senior who set up voluntary withholding years ago during a higher income period and then forgot about it may be having money taken out of every check for a tax liability that no longer applies or that has been substantially reduced. Checking whether voluntary withholding is active on your account takes less than 5 minutes at SSA.gov under your My Social Security profile. If it is active and your income situation has changed, filing a new W-4V to reduce the withholding rate or stop it entirely restores that money to your monthly deposit immediately with the next payment cycle. It is also worth noting that the One Big Beautiful Bill signed in 2025 added a temporary senior bonus deduction of $6,000 per person, or $12,000 for eligible married couples filing jointly for tax years 2025 through 2028. This deduction applies on top of the existing standard deduction for seniors and is available whether you itemize or take the standard deduction. For beneficiaries whose combined income was sitting just above the taxation thresholds, this additional deduction may eliminate their Social Security tax liability entirely for the next 3 years, which means voluntary withholding set up to cover that liability is now overtaking money that does not need to be withheld at all. Review your withholding status now. Deduction number 5 is SSA overpayment recovery, and this is the one that has changed most dramatically in the past 12 months and is causing the most confusion and financial hardship for the seniors it affects. An overpayment occurs when the SSA pays a beneficiary more than they were entitled to receive, whether due to an unreported income change, a status change, an administrative error by the SSA itself, or any other discrepancy between what SSA paid and what the formula says should have been paid. When the SSA identifies an overpayment, it is required by law to recover that money, and the method it uses is withholding from future monthly checks. The policy on how much can be withheld has changed 3 times in the past 14 months, which is the source of enormous confusion for beneficiaries currently receiving overpayment notices. In March 2024, the SSA capped withholding at 10% of monthly benefits after widespread outcry over beneficiaries receiving notices demanding full repayment of overpayments, sometimes totaling tens of thousands of dollars caused by the SSA's own errors. Then, in March 2025, the SSA announced it was reinstating the original 100% withholding policy for new overpayments, meaning a beneficiary notified of an overpayment after March 27, 2025 could have their entire monthly check withheld until the balance was repaid. Then, in April 2025, the SSA walked that back again following further public backlash. settling on a default recovery rate of 50% for new Social Security overpayments, while SSI overpayments remain capped at 10%. The current policy as of March 2026 is that new Social Security overpayments are being recovered at 50% of monthly benefits by default, unless the beneficiary requests a lower rate. If you have received a notice of overpayment from the SSA in the last several months, you have 90 days from the date of that notice to appeal the SSA's determination that an overpayment occurred, to dispute the amount of the overpayment, or to request a waiver of repayment entirely on the grounds that the overpayment was not your fault and that repaying it would cause financial hardship. During any pending appeal or waiver request, the SSA is required to pause collection, which means filing that appeal immediately protects your full check while the process unfolds. If you do not dispute the overpayment but cannot afford 50% withholding, you can call 1-800-772-1213 and request a lower recovery rate. The SSA handles these on a case-by-case basis, and flexible repayment arrangements, including rates as low as $10 per month, are available. The critical action is to respond to any overpayment notice immediately, rather than ignoring it, because a notice that goes unanswered converts automatically to withholding at the default rate with no further warning. One thing Evelyn can do today, before her next deposit date, is go to SSA.gov, log into her My Social Security account, and review her benefit payment details to see exactly what deductions are listed against her benefit amount and what each one is labeled. That breakdown exists in her account, and it is the fastest way to identify which of these 5 deductions is accounting for the dollars missing from her check. 5 minutes of that review is worth more than an hour on hold. If you are not yet subscribed to U.S. Pension Insight, please hit that subscribe button right now. It is completely free, and this channel exists so no senior loses money without knowing exactly why and how to stop it. 5 deductions. 1. Part B at $202.90, up $17.90. 2. IRMAA adding up to $487 per month based on 2024 income, appealable with Form SSA-44 if income dropped. 3. Federal student loan Social Security offsets, legally authorized but paused, and rehabilitation removes eligibility entirely. 4. Voluntary tax withholding from a prior W-4V may be running and can be stopped at SSA.gov. 5. SSA overpayment recovery at 50% default for new cases, appealable within 90 days or reducible by calling 1-800-772-1213. Evelyn logged into her My Social Security account the next morning and found a voluntary tax withholding she had set up 4 years ago and completely forgotten about. She filed a new W-4V the same day. She told me, "I spent 33 years teaching children to read carefully, and I missed this in my own paperwork. Now I know what to look for." That is exactly why this channel exists. Stay subscribed. I will see you in the next update.